Good morning and welcome back to the Georgetown Conference on Market Quality. We now have an exciting panel looking at some of the recent empirical evidence on market quality. As the old saying goes, in God we trust, all others bring data. So now let's bring some data to this analysis. Our first speaker this morning will be Professor Krista Schwartz from the Wharton School. Krista, take it away.
So thanks very much for having me. First of all, I've already learned a lot this morning, and I'm going to shift focus a bit because the talk that I have on some research I've been doing is with regards to fixed income markets, not anything to do with equities, but still along the same spirit. So I'm going to start off and motivate the topic by showing a quick film, I hope, a film on the yield curve. And this is showing the cross-section of yields. Every single dot is a different security. So the blue diamonds, those represent securities that are originally issued with 30 years to maturity bonds. The others are notes, the black stars. And as you can see here, over time, 2008, this curve is splitting into two separate curves that are running concurrently. So instead of one yield curve, we have two curves. At the peak, this is running through 2009 now. At the peak, it's about 1% in difference. And even through the end of 2009, you can see the blue diamonds, the bonds are hovering, their yields are hovering above the notes. Microphone? So this type of anomaly, this type of mispricing, is something that in the Treasury market in particular is just absolutely unprecedented and highly unusual. This is an extraordinarily large market. The Treasury market alone is, one issuer bigger than the entire corporate market, all the issuers. And this is a market in which you have the ability to replicate the cash flows of one Treasury security with other securities in that same market. So no fancy derivatives needed or anything like that. Now, another way to look at this anomaly, a more two-dimensional way, is say I take one of the blue diamonds, one of the black stars that are right on top of one another, and I look at the yield spread over time between those two. And that's what I'm doing here. So these are two matched maturity securities. They matured earlier this year, February 15th, 2015. This chart goes through 2011. And you can see that, the yields between them differ, and there's variation over time. You might say to me, OK, fine. This is a raw yield spread between a bond and a note. Bond was issued in the 80s, higher coupon, shorter duration. No kidding that the spreads are going to differ. So what I can do to address that is I can take a zero coupon Treasury strip and add that in a certain proportion to the bond such that I can create a portfolio with the bond and the strip that precisely replicates the cash flows, the coupon payments, everything in the note. So I have two portfolios, replicating portfolios that are effectively identical, and the yield spread between these two is shown in the blue line. So that's even bigger a spread. This should be zero. These are two securities that in every respect are effectively identical. They're treasuries, same risk, same everything. The spread spikes at around 90 basis points there at the peak. Now, we look at this anomaly in a few different ways. And first, I thought it might be intuitive to just think through how might I structure the arbitrage to take advantage of this trade. So I'd go long the cheap security, short the expensive security, and that means long the bond, short the note. And so there are certain things in the market that could affect one side of this trade different from the other. Notably, in the specials market, we have specials transactions frequency from a large interdealer broker, and what we see is that right at the time that the anomaly peaks to its highest, you see a sharp fall in the frequency of specials transactions. So I'd have to access the specials market to get the note, to deliver it into the short sale, And perhaps this was amid high fails to deliver also when there wasn't a penalty to do so in the Treasury market. Perhaps I had a problem. If I were a would-be arbitrageur, I perhaps couldn't have easily accessed that note to short into it. I should also mention that the net funding costs for this trade, so borrowing at, let's say, GC to go long the bond, and then the specials rate to short the note, because rates were so low at the time, that was just a tiny, tiny, tiny fraction of the potential returns to this trade. And they stayed tiny, given that this is already matured. So another way to think about this, perhaps more fundamentally, is to think about these securities and what might make the bond versus the note relatively more attractive for an investor. Is there something about their characteristics? And so what we do is we take a smoothed curve that is fit to all nominal treasuries outstanding, and we look at the individual prices of every security relative to this smooth curve. And we say, is there some way that we can relate the price deviation of a given security to some characteristic about it? So its age, its amount outstanding, et cetera. And what we find is that there are certain characteristics that matter more than others. So the bid-ask spread is very important. Higher spread, cheaper security. The share stripped, that means the less outstanding in whole tradable form. So effectively lower amount outstanding, and that makes the security cheaper. Higher trading volume, more liquid, richer. And we also thought it was interesting that the coefficient estimates on these regressors, on these characteristics, they varied a lot over time. So looking at them more closely, we found that while the time variation was enormous, they all had the same pattern. Sensitivity goes up in the crisis, comes back down to previous levels afterward, except for the bid-ask spread. With the bid-ask spread, we found that the sensitivity of this pricing deviation to the bid-ask spread increased in the crisis and then just continued to go up from there. So now it's at a sensitivity that's higher than it was at the peak of the crisis. So this motivates us to take a little bit of a closer look at the bid-ask spread. And here I have a picture that shows in blue. This is the average 30-year bid-ask spread from 2005 to 2011, and the average 10-year bid-ask spread in black from 2005 to 2011. And you can see, yeah, they both spike in the crisis, and they're at pretty steady levels beforehand, and it looks like they've reached some sort of a steady state afterward as well. But the curious thing is that this is a higher level that they're remaining at post-crisis. So they haven't reverted to their pre-crisis sort of norm. And so we tried to see if there was something that could help us understand this new normal in the bid-ask spreads and the levels of bid-ask spreads. And one variable that we found that seemed to help explain that was a gradual tick up over time in the time to trade. So this is the time in between trades for a given security, for any individual security. And that has gone up over time and has not come back down. Now, the final sort of angle at which we look at this arbitrage is to understand who were those investors that were either engaging in the arbitrage on the right side of the trade, or clearly there were sufficient on the other side of the trade that it lasted for a period of months and it grew pretty large. And so is there something that we can find in the characteristic or the profile of an investor who would be on either side of the trade that can inform us about perhaps their influence on the price movement? So we have individual treasury transactions for all US insurers, every single security, every single day when they've traded it, and we look at their net trades, so going long the cheap thing, short the expensive thing, to sort of mimic the arbitrage, and then we relate that to the pricing error. So the net transactions of the insurers, then how does this relate to a security either becoming more expensive or less expensive? And we find that the investors that actually exploited the arbitrage. Those were more buy and hold investors, long horizon investors. Makes sense because for this to be technically an arbitrage, you'd have to hold it to maturity. And those who are better capitalized. So that's intuitive. And then the investors that were on the other side of the trade are those who may be more sensitive to liquidity shocks, annuity-based investors subject to redemptions, more levered investors, and those who traded more frequently, those who trade more frequently. And so that makes sense too, because they're buying the expensive security as it becomes more expensive, and perhaps that's in an aim to have liquidity, which is something that they seem to be needing very badly. Now, how does this relate to things today, to the Treasury market today? Well, the anomaly has largely faded away, though it seems that there is still a bit of a divergence. Normal arbitrage relationships have resumed, but the Treasury market isn't quite the same as it was pre-crisis. And the evidence that we've shown of a new normal, this is something that looking at very recent data, it's consistent. So this goes through just this past year here. We see depth of order book for Treasury securities. It came down in the crisis and has come down even more sharply. This is for on the runs in the past year, the past few months. Trade size also has come down more recently, not as sharply as the depth of the order book, but nonetheless interesting. And so some factors that you could point to as perhaps worsening liquidity in the market are regulatory restrictions on the repo market. This affects the cash market as well, causes dealers to be less willing to hold positions. The rise of electronic trading, this is something that has occurred across markets, and we've already talked about high-frequency trading. The reliance on high-frequency traders now as liquidity providers and as market makers is something that is relatively new, particularly in the Treasury market. And these things have produced limited but notable cases of volatility, such as someone had talked about earlier, October 15th, when the 10-year Treasury fell 37 basis points on no news in a matter of moments. And what this all says going forward, perhaps, is that the Treasury market in a future crisis may be less resilient, may be more subject to shocks. And given that both policymakers and investors, they rely on these arbitrage relationships that exist, and for monetary policy, the Treasury market is very important, that might be different in a future crisis.
Thank you. We'll now move to Larry Harris's paper with some very brand new data. This is the world premiere, and I think you'll all find it very interesting.
Thank you, Jim. Before I start my formal presentation, I'd like to share with you one question and one observation that I'd like you to keep in mind as I go through my presentation. So the first question is the following. We're all familiar with broker-dealers, and the question is when is a broker-dealer a broker, and when is a broker-dealer a dealer? And then the observation, which seems very different but also relevant to this presentation, is the following. From the point of view of a computer system, the only difference between one security and another, whether they're equities or whether they are bonds, is their CUSIP number. So with that, let's get started. We're going to talk about transaction costs, trade-throughs, riskless principal trading in the corporate bond markets. Okay, so there we go. So let's first talk about the issues. Unlike commissions, customers don't see the dealer markups before they trade. They can see them after the fact, as was observed earlier today, by looking at the trace data, but that's pretty time intensive. This is an issue because for many transactions I'll shortly show you, there's essentially no difference between commissions and markups. They're functionally exactly the same. Customers generally don't see the best bid and best offer prices before they trade. They have to query multiple dealers, which is prohibitive for small traders and even for mid-sized institutional traders. There's some market structure issues that we also want to be thinking about before we go to these results. Customers can't effectively offer liquidity in these dealer markets, in contrast to the equity markets where it's very easy to post limit orders. Not even in the electronic order-driven venues. Certainly retail can't get there, and many institutions can't get there either. There are no trade-through rules that protect standing orders, so if you give a limit order to a dealer, you're just giving a trading option to the dealer and to nobody else. And then finally, few brokers allow their customers to see what's going on in these venues. There is almost no pre-trade transparency. I'm going to shortly show you that there's an awful lot of information that is available pre-trade. And then finally, let's observe that payments for order flow effectively prevent most uninformed customers from benefiting from innovative trading technologies, because their brokers are sending the orders to dealers because the dealers are paying them and not sending them elsewhere where the customers potentially could get better execution. And so the question before us is, how important are these issues? And to that end, we have to examine the data. So what's the net result? All of us are very well aware of this. Small traders and many large traders trade at a disadvantage because they don't know the market prices as well as dealers do. And I'll just share with you an observation that you've probably heard before, but you certainly know. If you want to convince somebody of this fact, simply ask yourself, how much better off would you have been if you knew the prices at which the used car dealer was trading cars, or the new car dealer, before you went in? They have an advantage because they know the market better than you do. If you say, I'd like to buy this car, and you bid too low, what happens? I can't trade with you at that price. I'd really love to, but I'll lose money. Okay? And if you come in and bid too much, what happens? You hear exactly the same thing. I can't trade with you at that price. I'm going to lose money. But you know, for you, let me go ask my manager and see if I can do it. Okay? And of course, what's the net result? Is that you're able to buy. When you do buy, you overpay. And when you don't, it's because you underbid, but you didn't know that. Okay, so transaction costs are very high in bond markets in comparison to transaction costs in equities. And anybody who's familiar with the determinants of transaction costs finds it really surprising because risk considerations, which are by far and away the most important, there are search costs, and we'll talk about that. The risk considerations suggest the opposite because equities are far more riskier than bonds. So what's my contribution to this story? In this study, I compare 3 million trace trades to about 464 million contemporaneous quotes in electronic venues. This is the first time anybody's had contemporaneous quotes. So I basically have the closest thing to the MBBO for bond markets. And this is what makes this story interesting. And with this, I can directly measure transaction costs. We don't have to deal with econometric models as we've done before in the past. Many of you know I've done this. We can identify trade-throughs. So we can ask ourselves, when we see trading through, is this guy acting as a broker or a dealer? And we can determine which of those trade-throughs are riskless principal trades. Since that's a big phrase, I abbreviate it to RPTs, riskless principal trades. Okay, so the quote data come from Interactive Brokers, and perhaps I should disclaim, as I should have at the beginning. My comments are only mine. I'm the lead independent director for Interactive Brokers, also a chaired professor at USC. Both organizations, in my opinion, would greatly benefit from the policy prescriptions that I'm going to offer at the end of my talk today. But I don't speak for them. I'm only speaking for myself. Nobody asked me to do this paper either at Interactive or at USC or anywhere else. This was an issue that I was been keenly interested in from before I was chief economist at the SEC. Interactive Broker provided me a record of the best bids and offers that they collected in more than 17,000 corporate bonds between December 15th and, of the last year and April 15th. They consolidate all these bids and offers from a whole bunch of electronic systems, in effect creating an NBBO. It's privately created. They do this for the benefit of their clients, who they allow to trade directly on these venues. So there are brokers who, through whom you can trade if you want to go directly to these venues. It's basically Interactive, and I don't know if there's anybody else. I hope that there are. Similar data, of course, have never been analyzed before. So now I'm going to condense 32 tables into just a few very quick slides to give you the essence of the paper. So trade activity. As you all know, most bonds only traded very, very infrequently. So this is the median bond only traded once every 3 days. But about 1% of the bonds traded more than 22 times per day on average. This is information that comes from the trace data. It's not from Interactive. Okay, so there's a good number of bonds that look a lot like they might be small and even medium cap stocks. Okay, now a quote activity, and this came from Interactive. The median bond was quoted to Interactive brokers 116 times per day. And that median bond had a bid present almost 100% of the time. And this is a time-weighted average, okay? And an offer present maybe 77% of the time. There's an asymmetry there that has to do with interesting asymmetries that are present in the bond markets that we could talk about later if you're interested. About 10% of all bonds had two-sided markets during almost 100% of the time. So again, we're looking a lot like equities. So let's now talk about transaction costs. The average customer round-trip transaction cost was 125 basis points. How do I measure transaction costs? I compare the trade price to the midpoint of the bid-ask spread. Okay, the simplest method out there. It's called the effective spread. That's equivalent to 50 cents a share for a $40 stock. That's pretty wide. That's pretty deep. Okay, and it's also equivalent to about 4 months of interest on 4% bonds. These are not exactly desirable conditions for small investors. The costs are much smaller for larger traders because the larger traders know the market much better. They can demand better quotes, and their business is a lot more attractive, and they're not corrupted by the agency problems associated with payment for order flow. The interdealer trades are cheaper, of course, because they know the market and they're trading with their peers. Now let's talk about trade-through frequencies. A trade-through is what happens when somebody trades at a worse price than a price that was available at some venue. Now, the person doing the trade-through may not have been aware of that worse price, which, of course, is a strong argument for having better pre-trade price transparency. Almost 47% of all trades traded through a standing quote when there was a two-sided market and when the quote was standing for more than 2 seconds. Now, we want the quote to be standing long enough so that we could say, if you knew about it, you could have gotten it. Okay? And by the way, the two-sided quote is not a significant restriction, as we already noted. We're seeing that most of the time. So we're seeing a lot of trade-throughs. The world would be very, very different if we had a trade-through restriction. Not necessarily better, but very different. In my opinion, better. Okay, let's talk about how to identify risk-free, riskless principal trades using the trace data. And I'm using the public version of the trace data. If you get it from FINRA, presumably you can identify these trades easily because you can see the actual dealers and match up the dealers. But just looking at the data, it's very simple. You look at all prices in sequence as they're reported for a given CUSIP, for a given bond, and you see which trades took place at the same quantities. Okay? And if the quantities were really close, if the trades were very close together in time, they probably are a riskless principal trade, and especially if one of the trades was an interdealer trade and the other dealer was a trade reported as a dealer trading with a customer, or if you see two trades where one of the trades was a dealer reporting that he bought from a customer and then another trade reporting that the dealer sold to a customer. Okay, so everybody who is familiar with these markets knows that these are indeed mostly riskless principal trades, and I'm treating them as such, although in practice it's probably best to call them potential riskless principal trades. But some strong evidence that I'll show you in a moment suggests that there's no question that these are what they are. Okay, and of course I'm careful not to double count trades when I'm counting these up. Okay, so about 42% of all trades in trace are potential riskless principal trades, pairs for which the time between trades is less than 1 second. 1 minute. Most of these are just 2 seconds apart. Okay. So what are the markups on these? So about 45% of these have no markups at all, and that's pretty good. Okay. The average markup for the non-zero riskless principal trades, though, is 54 basis points. Markups are greatest for the retail trades, no surprise there. The total markup value on these trades is 2/3 of $1 billion for the year. Okay. Trade-throughs by their status, about 32% of all trade-throughs are this riskless principal trades. For these trades, the median difference between the markup and the price disimprovement is about 0. The correlation between those markups and the price disimprovement coming from two different sources of data is about minus 86%, the biggest correlation I've ever seen in anything that I cared about in my research during my life. So for your full year projections, the total customer bond transaction cost, what people paid for liquidity last year, was almost $26 billion. The trade-through value, what was lost because better prices weren't obtained, and this is based on the reported quoted size, about $700 million. There's a lot of big numbers in here. So the policy recommendations, I'm out of time, but I'll go very quickly here. We're asking for greater pre-trade transparency. I think that's very important. Better market structure, the same things that I spoke about at the very beginning, allowing people to participate in these markets. Some telling observations, many of you have heard this before. There's not much difference between a bond and the combination of treasury interest and equity interest. Both of those elements trade in completely transparent markets. What is there about tying the two together into a corporate bond that requires it to trade in an opaque market? And then a final observation that I won't spend too much time on, but I'll note that trading in exchange-based markets was very liquid in the 40s, through the 40s for corporates and through the 20s for municipal bonds. And then the transaction costs were lower. Okay? And also the markets are better in Europe where they have more pre-trade transparency. Some would say that the markets are rigged against them. I hate to do that, but I couldn't resist just putting it there.
Thank you. And next we are going to move from fixed income back to the equity world. And Charles Jones from Columbia will talk about the talk about pilot programs.
Thank you very much, Jim. I think we're set here. Great. Thank you. So we want to turn our attention back to equity markets for a minute, and I want to talk generally about regulatory pilots and sort of what we can learn from them and how we might design them and some of the pitfalls in designing and interpreting what comes from them. So I want to start by talking a little bit about the tick size pilot that is sort of on the plate. I know some of you are living this on a very detailed day-to-day basis and trying to get ready for it coming up. Others of you may have just sort of seen it a little bit in the news, and some of you may be completely unfamiliar with it. Let me show you some data on why we are embarking on this particular experiment. So this is data from ITG on trading costs by large institutions. Now, these are implementation shortfalls, if you know that particular trading cost measure, combined with explicit commissions that are actually being paid. And what you see here is this is a graph over the last 10 years or so that basically large cap trading costs have trended down. Right? There's a peak there in the financial crisis, but they are better than they sort of ever have been. And actually, Larry and Jim have another paper using some slightly different data where they show some of the same kinds of graphs. So this is, this is sort of our evidence that we're doing something right. The previous panel said we're doing something right with equity market structure, and this suggests that, in fact, we are doing something right at least most of the time. Now, the problem is that small caps, the graph doesn't look like this. Okay, so if we look at small cap trading costs, same measures, implementation shortfalls plus commissions, those have never gotten back to where they were in the mid-2000s, okay, about a decade ago. They're much higher, at least by ITG's trading cost database measures. Those costs are not nearly as, have not improved in the same way. So there is something not quite working right in small cap market structure for equities, or at least not as well as it used to. And this is somewhat surprising because really they're subject to, essentially the same market structure, the same regulatory framework. So there are a bunch of possible explanations for this. It could be something unusual about the ITG sample. It could be something about the current market structure. It could be that that now we have sort of the right trading cost level, and before we had some cross-subsidization where NYSE specialists and others might have been subsidizing the performance in small caps and liquidity in small caps based on some of their profits in large caps. It's hard to know, right? And so that's really why we want to do an experiment, and that's really why the SEC and Congress are mandating such an experiment. So what are the elements of this? It will start in May 2016, and for all stocks that are illiquid and small in terms of market cap, the tick size is going to widen out for a subset of those from pennies to nickels. And there will also be restrictions on how trades can happen internalized at a broker-dealer or in dark off-exchange venues. And so we'll basically be I can give you more details on it, and there's a great deal of detail that's been provided on this, but they're basically going to be 4 buckets. There's going to be a set of control stocks, and there are going to be 3 sets of experiments that we undertake to try to figure out what the impacts are of these different things, widening the tick and also restricting some of the trading that could take place at dark venues. And so it's really it's sort of what we would call the gold standard of experimental science, right? This is virtually a randomized controlled trial, which the advantage of it is it really makes statistics easy, and we can just compare the treatment stocks to the control stocks that are unaffected by the rule changes. That's the basic idea. The problem, of course, is that it really has to be the experiment really has to work in the sense that the control stocks really have to be unaffected. Okay? And I have a paper with colleagues Eckert Boehmer and Xiaoyan Zhang where we identify some problems if the pilots actually have some sort of spillover effect onto the control stocks. Okay? So if the control stocks really are not controls, then interpretation is a lot harder. We have to think a lot harder about how to interpret the results. Okay? So you might say, how could control stocks be affected here? What could possibly be going on? What could be going on in this particular case? Well, let me show you the example that's from our paper and give you a sense of how this could be a problem. The last great pilot that the SEC undertook was the repeal of the uptick rule starting in 2005, and then there was final repeal of the uptick rule after the pilot had gone on for a couple of years in 2007. Well, what happened on the final repeal? Basically, there were some pilot stocks. There were 1,000 pilot stocks. And then there were 2,000 other stocks that suddenly had the uptick rule repealed. And what did that do? That made it a lot easier for people to short sell without any sort of restriction. So this was the uptick rule that limited short selling to markets that were moving up and limiting short sales in declining markets. And what ended up happening? Well, what ended up happening is that this was designed by the SEC, and this was designed to be very easy to interpret, that we'd have a set of treatment stocks that would start out being have this uptick rule repealed, and then we'd have a set of control stocks where the uptick rule remained in place, and it would be very easy to actually do the statistics and do the calculations and figure out what the effect was. And for those of you who know some econometrics, you would just basically do a differences in differences regression and basically figure the changes in the treatment stocks versus the changes in market quality or whatever it is you're looking at in the control stocks. Well, what was the problem with this design in the case of the short sale uptick rule? Well, in this particular case, why were the controls not the controls? Well, the problem is that there are a lot of short sellers out there who are doing portfolio strategies. Okay? Think index arbitrage. I'm going to buy the ETF and maybe short sell all the components all at once. Okay? I need to be able to immediately short sell all those components all at one time. And so it doesn't help me to have 1/3 of the stocks exempt from the uptick rule. I really need to have all the stocks exempt from the uptick rule. And so in 2007, when we repealed the uptick rule for the remaining 2,000 stocks, suddenly index arbitrage and other portfolio shorting strategies got a lot easier. And so, in fact, what we observed was a lot more aggressive short selling by not just not in just the affected stocks, but also in the control stocks. And so I have a picture to show that to you. You can sort of see this here. This is basically how much of the bid-ask spread these short sellers pay. And the control stocks here are the pilot stocks. So that red line is really the control stocks, and the blue stocks are really the treatment stocks. Well, they move together. The stocks are going to be treated similarly afterward, right? But what you also see is there's an effect in the control stocks. Okay? So in fact, actually, in the control stocks, short sellers got a lot more aggressive as well. Okay? So this would actually cause you to change your conclusion about the effect of these short selling restrictions if you weren't taking into account the effect on the control stocks. So let's circle back to the planned tick size pilot. So what's the problem here? What's the potential spillover? What do we need to be watching out for when we interpret the results here? Well, I can think of several, but the most obvious one to me is that we're going to have 4 buckets here for a bunch of small cap illiquid stocks. We have a whole lot of coding that has to go on in all sorts of places, exchanges and brokers, and everybody has to adjust. We heard about this in the previous panel. Well, what if some people just say, geez, I'm not going to deal with this, right? I just want to step back from this entire small cap world, and I'm not going to trade any of these guys, right? Well, if I decide I'm not going to trade any of these guys or I'm going to trade them less, right, that's going to affect the control stocks because some of these small cap illiquid stocks are at least at least theoretically unaffected by the rules. Okay? And so if that happens, then we should be worried. Of course, there's an easy way to find that out, right? We can just look at trading activity in all small caps, and if that changes substantially, then we know we're in trouble. Okay? So for anybody who's sort of thinking about this, I don't want to say that I know we have quite a few regulators in the audience, and we have a lot of participants here who have different views, I think, generally about pilots. I don't want to say that pilots are a bad thing to do. I still think they're the best thing we've got going if we really need to try to identify what's going on, right? But what we have to do is we have to be super careful about these spillover effects, and we have to be super careful about interpreting the results that come out. And we also need to think carefully about designing these pilots to minimize those effects, to minimize the costs of implementation, and to maximize the amount of information that we are going to gain from this. Now, I'll give you my own forecast of what I think is going to come out of this tick size pilot, which is we've actually done quite a bit of work in academia over the last couple of decades on tick sizes and various other things, and none of that evidence suggests that widening the tick is going to do any good for the liquidity in these small cap stocks. So I do not think we're actually going to see any benefit from this particular pilot. But we'll have to let the data speak for themselves, and those data will tell us whether our priors on that are exactly right. I'm less certain about the effects of trade at, these restrictions on internalization and trading in the dark venues. I think that particular aspect of the pilot could be particularly interesting. I'm a little disappointed that we're trying this in small cap illiquid stocks because I actually think that the problem of not the problem, but the issues associated with fragmentation and dark pools and internalization are really issues that cross the board in terms of the cross-section of stocks. I think the issues are big for large cap stocks here, and so I would hope that at some point we start to think about those kinds of issues for large caps and not just for small cap illiquid stocks. And so I will leave it there.
Thank you. And next, we will go into discussion mode with our 2 commentators. We'll start with Greg Berman, who is formerly from the SEC, now with E&Y.
Thanks very much, Jim. As you can see, as Jim mentioned, I have a little tombstone. I guess something happened between 2009 and 2015. Could have done a different format. Looks a little strange. So yes, I'm no longer at the SEC. I just joined E&Y, which means I no longer need to give the standard SEC disclaimer that my views do not represent the Commission, which also I guess that means now my views do represent the Commission. I don't understand the logic, but there are certain things that maybe just not meant to be understood. So the title of this panel is really about market quality and what is market quality. And that got me a little nervous. How many people here have read Zen and the Art of Motorcycle Maintenance? Okay, if your hand is not up, it should be. You definitely need to read this. The book is about 60 years old. I think it was written in the 50s. And it's a true story. And it focuses on an individual who likes motorcycles and who asks himself, because he is asked to comment on what is quality. And as the chapters go by, he goes insane. And he winds up spending decades in an institution. He has electroshock therapy. And it's only when he gets out that he finally has a chance to try to piece his life back together. So this is an area that we really need to approach very, very carefully. And there's reasons. You can go down a rabbit hole when you start thinking about market quality. And I've been thinking about this actually for quite some time, especially when I was at the SEC, because we were always asked to opine on a whole bunch of different policies that were related to improving the markets. And the struggle, I think, that both regulators and non-regulators have, which is quite different from the struggle that industry has, is everything that we measure today is relative. We have absolutely no absolutes. And we can see that in some of the papers that were just presented. So an example would be, we look at the bid-ask spread, and we say, well, that's a measure of quality. Well, it certainly is an input into quality, but it can't be the measure of quality. And the reason why is that we have a gut instinct of that. We know in the May 6th flash crash of 2010, when the market plummeted, most people said, that's probably poor quality. That wasn't a good thing. Why? There was no news. Stocks traded a penny. We know why stocks traded a penny, because market makers completely pulled back. And while market makers completely pulled back, there were still people who were trading. Not a good sign of market quality. However, as we heard in the very first panel, lots of people patting themselves on the back as an industry for the way August 24th was handled. What's the difference between the plummeting aspects of August 24th and the flash crash? Take out the very good points that Andy made, because I agree with Andy on that also, about the opening stocks. But if you just look at the broad way that stocks move, what was the big difference? The big difference was that on August 24th, there was macroeconomic news. There were investors. There were things that were happening that you couldn't match that back to what happened during the equity flash crash. So you have the same output, but you have a different conclusion over whether or not the market exhibited good quality or bad quality. So if you look at spreads for a stock, and you say the spread of the stock used to be 3 cents, now it's 2 cents. I have no idea whether or not that's indicative of better market quality or worse market quality. The reason is there's no math, or at least there's no math that I have been able to find, that says actually the proper spread for that stock is a penny based on objective independent needs of investors. So you take out all the markets, all the intermediaries, say the proper spread should be a penny, and here's a model. The spread is actually 3 cents. That's probably an indication of poor market quality. On the flip side, you may find out that based on the needs of investors and portfolio managers, institutions and retail investors, their flow, this is a 17-cent spread stock. That's the economics. Yet it's trading at 4 cents. That's also poor market quality. And in fact, you'd actually want to see larger spreads and not lower spreads, because you'd be pulling away from that market quality. So in very few places in our society do we not have absolutes. We don't go to a store or buy a car and say, I have absolutely no idea what this is really supposed to cost. You would probably not buy a cappuccino at wherever if it was $37, because you just sort of know that it doesn't cost that much. You might actually be a little leery of buying a cappuccino for 10 cents, because you sort of can't buy coffee that cheap. So I don't know what's in it. So you need to have some absolutes. So now, reflecting on some of the paper around the papers today, the one that I'll mention is that I thought was quite interesting was one that Krista presented, because it had something that was very novel. And I know, Krista, you didn't really discuss that much, but in analyzing spreads for and the lack of quality or the decline quality in the Treasury market because of that, the spreads changing between the different bonds, Krista added in a new factor. What was going on with insurance companies? What were they actually doing? And I think if you go into the paper, you'll find that that had a very, very large impact on what actually happened. It was a material, substantive issue. And that's something that we need to do a lot more of in the equity markets especially, so that we have a better sense of whether or not we have a stable quality and not just a declining or an increasing quality. Thank you.
And next we have Eric Siri.
Thanks, Jim. So we heard 3 papers, one on experimental design, one on liquidity for treasuries, and one on markups and trade-throughs and corporate bonds. It's a little hard to tie those together. They're very different, but they are, of course, securities, so they do have a gross function that's constant. They raise capital for issuers who have good ideas and good projects. But equities and bonds have much different traits with regard to the regulatory issues. People are complaining, both here and other places, that, for example, equities are too fast, they trade too fast. No one questions the ability of investors to get pre-trade information. In fact, if anything, we would say there's too much pre-trade information. And the way we measured pre-trade information there is measured in milliseconds, if not microseconds, because it comes so quickly. That's, of course, not old. I was reading a book recently about the history of information, and it pointed out that in the late 1800s, a group of private investors got together with a telegraph to run an undersea cable from the London Stock Exchange to the Paris Bourse to engage in trading and to beat guys who were using the public telegraph to trade between those 2 exchanges. So if you know Reg NMS and its allowance of private linkages, you will see the echo, today's echo of the past, which is that people have been searching for speed for quite a long time. So the equity markets are really characterized by a lot of transparency, a lot of speed, contrast with the fixed income markets, where broadly what was talked about here was opacity, especially from Larry, expensiveness, difficulty to trade. Larry pointed out that these bonds, a lot of the corporate bonds at least, trade 2 or 3 times a week. Municipal bonds, if you're interested in those, trade far less frequently. So it seemed to me what these 2 markets had in common, at least with regard to the issues we talked about, were 2 things, I thought. One was liquidity, and the other was the role of intermediaries in these markets. So with regard to liquidity first, the equity markets are somewhat unusual because we've seen an evolution away from people like designated, even there are such entities called designated liquidity providers. We've seen an evolution away from statutory market makers, rule-based market makers, who have obligations, to what you might call episodic market makers, high-frequency traders, people who swoop in and out just because they want to or it's in their interest. I'm not sure that's so much a regulatory choice as it is a reaction to market conditions. If you go back to the late 2000s, the exchanges voluntarily wanted to step away from their obligations, the trade-off they'd always made with market makers. Market makers, regulatory market makers, cut a deal. Their deal was always, we'll take some obligations if you give us some benefit. And the SEC managed that trade-off. They would stand up and be agent for the book. So act in an agency capacity to represent your order on an exchange, act in your interest, for which they'd collect a fee. And for doing that, and for trading when they should trade if there's no market, whether it worked well or not, they gained an advantage of time and place, which they used often to their advantage. That model became unviable in the late 2000s because the people who were in that model started losing money. The trade-off wasn't worth it. The regulator backed off, the SEC backed off some of the obligations. It didn't clear the market. The NYSE in the end had the specialists, which there were, give up the agency obligation for the book, and they just didn't want that trade-off anymore, and other markets followed. So the idea of having someone who just stood there and made markets in the traditional way, that went away as a viable trade-off. Now, that has a lot of implications. We've talked about some of them here. I just want to mention one that we hadn't talked about that comes up from time to time, and that's the price. So the reason why I mention the price is I want to talk about it with regard to derivatively priced things. I don't mean options, swaps, kind of derivatives, but I mean things like mutual funds. So something like a mutual fund where Andy works. Mutual funds rely on the price in a very, very important way. They strike a NAV at the end of the day. They aggregate all the prices to value their portfolio. But that mutual fund guarantees infinite liquidity at that price. Anyone throughout the day can place a buy or sell order, and they get to buy an infinite or sell, up to their ownership, an infinite amount of shares at one price. So they're writing an infinite liquidity guarantee at a price that now you've got to question how valid it is. If you think about Krista's paper, and step back from it, what it says broadly to me is that all of a sudden concerns about liquidity episodically crept into the price of a particular bond, the long bond. Well, whether or not a fund wants to account for that in their pricing of the NAV is an interesting question. Her dislocation was very long dated, so presumably they would. But if the dislocations are much shorter, then a fund company or anyone who's derivatively pricing a security has got to ask, do I want to include these sort of liquidity-based dislocations in the way I price my securities and the way I price my portfolio securities? Or, if you want to take it to another place of an entity that uses price, folks who risk manage. Anyone who's risk managing a financial intermediary cares desperately about the price. It's one of the primary inputs to risk management. If you're trying to risk manage something and you can't separate liquidity effects from fundamental valuation effects, then you're going to have to think about, you want to be able to do that. And if you fundamentally can't unravel them, then that's I think, a cause for concern. The regulatory implication, of course, is that you want to create policies that, if possible, to enhance liquidity and at a minimum try and separate those two, I think. Turning to the role of intermediaries, then, last comment. Intermediaries, and I'm going to talk about intermediaries as they relate to retail folks as opposed to institutional folks. So the common or the conventional standard that's used to have an intermediary deal with a retail folk is the idea of the obligation of an agent and their best execution. And the reason, not being an attorney, the way I understand this is, the problem is mom and pop or I or anybody else, none of us can judge the quality of an execution. You don't have someone standing up in a supermarket telling you about peanut butter or the price of peanut butter or anything like that else, because you can judge the price and you can judge the quality. But a normal person cannot judge the quality of an execution in a marketplace, whether it's stocks or bonds. And so the regulatory system injects an obligation on an intermediary to say, you've got to treat people appropriately in some way. What it means to be appropriate depends on the market and depends on time. But you've got to treat people appropriately. That standard, I would suggest, needs to change as markets change. So I'll give you a concrete example. Equity markets. In equity markets for retail investors, there was an old standard, and it wasn't that long ago, but you could pass the BESX test by shipping everything to New York. Some very large wirehouse brokers just sent all their retail orders to New York, and they were done. That was good enough. You pretty clearly would not pass today with such a standard, nor is it appropriate that you pass. But then you can ask yourself, well, what is the standard? The Commission has always said, the staff of the Commission has always said that the analysis is not an analysis that's order by order. It's something else. It's a process-based analysis. But folks have not really thought carefully about how the process has changed in terms of how equity markets have changed. I'll give you a concrete example. Suppose there's a price that's rock solid at 30. That is, at a moment a broker-dealer holds a customer order, they can sell that order at 30, for sure. But there's also a gamble that sits on the side of gamble, a risky place you can route, that gives them the 60% chance of selling at 31 and a 40% chance at selling at 29. Should the broker-dealer route to that venue, assuming the 30 vanishes? Well, if they have, in expectation, and I got to believe someone who runs a prop trading firm, it's not even an interesting question. Of course, they're going to route to the uncertain market because in expectation they're going to win that battle. But for a regulator looking at someone with flow to route, if you happen to get a 29 print when there was a sure 30, then that customer did not obtain the best price available in the market. So is that a violation or not? Well, if you look at the business statistically on a flow business, you're going to say, wait a minute. If there were two brokers, one guy takes the 30 and the other goes for the 60-40 gamble, I send my order to the 60-40 guy every time because I know in expectation that's what's going to happen. I'm not sure that the standards for how an agent's duties have evolved have kept up with that part of changing market structure, let alone the changes that Larry was talking about. Thank you.
Thank you, Eric. Before we open up to audience questions and comments, I'm going to inject my own comment just to sort of draw a few of the threads together. And we noticed from Krista's paper some dislocations in the bond market where the normal arbitrage activity fell apart in the financial crisis. We saw on August 24th the arbitrage activity that connects ETFs with the underlying cash markets fell apart. This is part of the new normal of financial markets. I'm a fan of technology. I don't want to go back to the old days of yelling and screaming at each other on a wooden trading floor, but we should be scared. This will happen again. if you look at how the arbitrageurs work, they work electronically. And they have their risk controls in place. No one wants to have the fate of Knight Capital Group and blow up instantly. So they very rationally have risk controls in place to look at things like the size of their position, the quality of the data feeds. There's a whole long list. And if they don't pass the risk checks, they don't trade. What this means is that the arbitrage activity in the next dislocation will automatically leave the market at that time. And we know what the results are like. So we need to be thinking about how can we improve market structure in such a way that when that arbitrage activity is pushed to the sidelines, which will happen again, how do we protect the price discovery in the markets? And with that scary comment, I will turn it over to the audience who would like to participate.
I had a question for Larry in reference to his recommendations on trace and some of the things that could be changed. One of the things that I've always thought about is the capping that occurs. Is that something that you saw as an issue when you were matching the orders and when you're looking to see the flows? I know with the 1 in the 5 million, is that part of the transparencies problems that you've talked about?
So the question concerns a characteristic of the trace data that's released for public examination. Trace only reports trades up to $1 million for speculative grade bonds. Above that, there's just a marker that says it's $1 million plus. And for investment grade bonds, they report up to $5 million, and then after that, there's a marker for $5 million plus. So the question is how important, I guess there's two parts to this question, or I interpret it this way. How important is this to the public? And then secondly, how did it affect my results? So with respect to importance to the public, frankly, I don't think it's that important. And in fact, I think it's very important that we protect dealers from revealing their positions too easily. So I think it's well advised. Now, with respect to my paper, I'm trying to measure transaction costs, and I don't know the full size of some percent of these trades. And of course, these are the biggest trades, so they're going to contribute most to the results. And so the answer here is, well, actually, the FINRA gives us this data, but with a couple years delay. So that's called the Enhanced Trace Database, and the Enhanced Trace is now available through 2012. So I went and I asked the question, well, for those trades marked $1 million plus and $5 million plus, how big were they on average in 2012? And the answer is the $1 million plus trades were about $6 or $7 million, and the $5 million plus trades were about $26 or $27 million, something like that, maybe 23. I don't remember exactly. And so what I did for this paper is I just assumed that on average, the trades that were marked 1 and 5 were in fact 6 and 23 or 25, whatever it was. And of course, my results are pretty sensitive to that because these are large trades. They account for 3 to 5% of the trades in the database, but they are the largest trades. So with respect to current, present time reporting, I think that we report too much post-trade information about trade sizes, both in these markets and in the equity markets. Mostly that information is used by people who are trying to not extract information about values, but extract information about positions so that they can go out and hurt other people. And so I'm not particularly concerned about reporting 1 million plus and 5 million plus. I wouldn't mind it if the FINRA gave us an enhanced database a little more current, because I don't think it matters much after a couple months. And then with respect to the equities, I think that we shouldn't be reporting every trade as it occurs with respect to its quantities. We should, of course, report the prices because they're very important. So we should report the prices, and then we should report every 10,000 shares traded a message that says, since the last time we reported, 10,000 shares in aggregate traded. And why do that? Because that will totally throw sand into the gears of those people who are using artificial intelligence mechanisms to detect algorithms. Those algorithms are, people are trying to avoid front running and quote matching strategies and stuff like that, and giving people all the information about sizes allows people to figure out what's going on with respect to the demands for liquidity. You could argue, well, that would allow them to better provide liquidity to those folks, but in truth, it really will allow them to front run those folks. So I think that the information ultimately is extremely important. We want to know the conviction that's attached to a particular price, and sometimes that conviction is measured by the amount that's traded at that price. But, you know, on an intraday basis or even on a day-to-day basis, get the prices in a reliable way. Maybe have a minimum threshold that says we won't show you all the super small odd lots unless they are starting to amount to something. But the quantities, they're just not that important. They are ultimately important, but not so quickly.
Can I comment just on one
Sure.
thing? I don't necessarily disagree with what you're saying, but there is a practical implication, which is that if you are trading, you do, in order to be a market maker, you need to see the order book because you're seeing your orders. Plus, you're also seeing your own executions and as that order book moves. So what's published in the equity market, say on the SIP, that's not used by the professional traders who are potentially doing the things that you're talking about. So they have to see that information in order to actually make a market. So you'd have to do something. What you wouldn't want to do is say no more large trades or something on the public feeds, which would pretty much only hurt retail investors who wouldn't know what's going on. But anybody who is actually trading would be able to clearly see what was going on just by the basic way that they were trading. So it would be tricky to figure out a mechanism for that.
I think I'm sensitive to those concerns. Let's make sure that we're very clear that we're talking about post-trade transparency, not pre-trade transparency. The devil will be in the details, but nobody's proposing this now. I talk about it because I think that, you know, the buy side complains about the front running of their algorithms. You want to do something about it, this is what you should do about it, but we'll leave it for another day.
The bid-ask spread has widened on treasuries, and the time to trade has increased, and yet the presence of high-frequency traders has also increased. You would think that that would actually shrink the bid-ask spread and actually quicken the time that it would take to trade. How do you square that?
So I am going to guess on this that high-frequency traders are likely more involved in on-the-run securities that are more frequently traded and that are sort of interdealer trades. And all of what I was looking at was security, any given security once it's off the run. And so it only reflected off-the-run bid-ask spreads and the relative bid-ask spreads for off-the-runs. I mean, everybody knows that, you know, the on-the-run 10-year is going to have a much lower bid-ask spread than the off-the-run 10-year. And so I guess it would actually be interesting to see what this phenomenon is like and if it is there as well in the on-the-run market. We stripped out on-the-runs explicitly because we didn't want to have our results affected by or have people think, oh, this is just the on-the-run, off-the-run spread and that blew out in the crisis and that's what it was. So we limited ourselves to just you know, stripping all that out, not having that affect our results, and just looking at off the runs. And just one other thing too, the data that we used was from a customer to dealer platform, TradeWeb, and so that, you know, may also be a factor.
In the back.
Thank you. Just one proposal to try to answer the question you initially asked. At the IMF, we've done some research on the October 15th flash crash, or flash rally, rather. And also in terms of recommendations, so how would you try to address those market dislocations? So, I mean, I guess in an ideal world, the first thing you would need to do is to first ensure that they are not going to happen. And for that, our thinking is more in terms of line of defense, right? For instance, the first line of defense could be to think about incentives for liquidity providers. whether through GMM, make-or-taker fees, or other type of incentives. Then if this doesn't work, then eventually that's where the trading halts, or more generally the market safeguard, should play a role. And so that's more or less at least two ways through which you might want to address those issues, which are also, by the way, slightly surprising, not discussed in the report made by the authorities.
I'll give a very, very simple solution to this, that we should simply get rid of market orders. I think some of these problems are just people who are foolishly trading into markets. A lot of markets don't accept anything but limit orders. And of course, limit orders can be marketable limit orders. But let people be responsible for what happens to their trades, and they'll learn very quickly.
And I would like to add that stop orders should be restricted to sophisticated investors. Many retail investors use stop orders thinking it provides a protection that they don't. However, one thing we need to be aware of is many of our well-meaning regulatory endeavors to improve the stability of markets, things like sponsored access restrictions, things like Reg SCI, have the paradoxical effect of increasing the straitjacket of the risk checks. Again, no one wants to be another Knight Capital Group on August 1, 2012. So the kill switches kick in automatically. This will happen in the next period of disruption. And we know from history that there will be times when macro or other news hits the market, and the market will go crazy. And at that time, arbitrage activity will be pushed to the sidelines, and this will cause further dislocations in prices. So this is an open question. There's no magic bullet to fix the market. Is it some kind of improved circuit breakers? Is it improved incentives for liquidity providers? This is something where we do need to have a good, broad public debate. And I think we have time for one more comment.
Trades with your desire for increased transparency on trace. I mean, if the market is fragmented and that large block has to be moved across several different broker-dealers, then the price is given out and the market would move against some of those retail investors who are invested in that fund. How would you square that?
So the corporate bond markets now are much more electronic than we really recognize. We have a lot of venues that are essentially running exchanges. The very fact that I have electronic data suggests that the market is very different. The dealers are benefiting from that, but the clients don't seem to be. Certainly not the retail. Now the question is, what about larger institutional clients? So our history of institutional trading in the equity markets that went from essentially manual to electronic is that the institutions did a lot better. They had to change the way they traded, had to use algorithms more, split things up. But when you reconstruct their trades, you take a large trade that was breaking into lots of small pieces and put it back together again and ask, what was the total transaction cost on that trade? Those total transaction costs actually dropped following the electronic the conversion of the markets to electronic trading. So what caused those transaction costs to drop? And it's either transaction cost drops that benefit both institutions and also individuals. And the answer is twofold. First of all, there's no question that the electronic systems are simply more efficient. And by being more efficient, it means that you're just paying less for people to do stuff that can be done by machines. The machines don't drop crumbs of pizza into their keyboards. They don't argue about their raises. They don't take up space. They just sit there and hum away. The second, and probably even more important, I think certainly even more important issue, is that the electronic systems have allowed the public to offer liquidity to the public in ways that are quite advantageous to everybody. And so it would be easier for a mutual fund to find another mutual fund who wants to take the opposite side position, whether they're splitting the order up in pieces or not. And it's easier to, mutual funds can acquire a lot of liquidity from lots and lots of retail traders if there's a way of finding out where they are. Right now, a retail trader wants to offer liquidity. It's essentially impossible, and the fund never benefits. So the expanding the network by allowing more people to offer liquidity is what's going to reduce transaction costs. Where will that lead the dealers in a bond market? The answer is the dealers will still remain very strong in the bond market because there are so many different names. So somebody wants to buy one name, somebody wants to buy another name. They're really closely correlated, but the two can't come together because they're in different names. And so a dealer ends up standing in between them, and the dealer will do well. What I find ironic is that the entire history of these innovations, as we've seen them applied to the equity markets, has been characterized by a phenomenal drop in transaction costs, and commissions, and market impacts, and so forth. And associated with that was a huge increase in trading volumes. It's not that dealers aren't going to do well in the future, it's that different types of dealers are going to do well in the future. So where it used to be that specialists and OTC market makers in the equity markets made a lot of money, now the money's being made by high-frequency traders, but they're competing against each other. Our biggest fear is whether the barriers to entry to being a high-frequency trader that are associated with acquiring so much high-speed technology, whether those barriers to entry end up creating a market situation where we have few high-frequency traders competing to offer liquidity. When that happens, it'll get more expensive. So overall, I think that the mutual funds will do well in this. But they need some help here, I'm afraid. I mean, they've made effort after effort after effort to organize their fixed income trading systems. And it doesn't seem to work. It seems that we really need to have something of a more integrated system. I'm not asking for the government to come in and specify a monopoly exchange or anything like that, but get some integration in the form of trade through protection, of simply display of order flow. I think that the world will proceed very nicely.
Thank you. It is time to move into the next segment of our exciting day, so let's give a round of applause to our panelists.